Mideast tensions hold at a simmer, U.S. retail sales bubbling over, and equity markets remain caught in the middle. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. We have the S&P 500 falling below 5,100 right now, 50.67. That's down 1.1%. We are at session lows right now. That retail sales report Romaine just mentioned, pushing out the idea of Fed interest rate cuts even further. You're seeing a sell-off in treasuries as well, with the 10-year yield moving up to 4.62%. At one point, the 2-year yield got super close to 5% as well. As we know, JP Morgan and Wells Fargo, among other banks, selling investment-grade bonds following their quarterly earnings. So some competition there for treasuries. We also see NYMEX crude now little changed on the day. It was interesting because for most of the session, oil had shrugged off Iran's attack on Israel, but now you're seeing it come back a little bit at about 85.60 for WTI, and dollar sees a strong bid. You actually have yen hitting a new low of 154.45. Watch for 155, Romaine. There's a lot of options with a strike price at 155 set to expire today.
Yeah, a lot to watch today, but let's zoom in for just a quick second on that 10-year yield. The Scarlet had up 10 basis points higher here on the day, and that renewed seesaw in Treasury rates, really reminiscent of some of the swings that we saw back in early 2023. As yields spike, so too does the volatility. The MOVE index, as of Friday, was already up 30% over the past 2 weeks, not far from the highest levels of the year. The only thing more volatile than the yields themselves, though, are the opinions on Wall Street as to where they go next. Bank of America's Mark Gurman seeing opportunities to go long duration, saying, look, there are no Fed hikes really in the cards right now. Gennady Goldberg over at TD Securities, he's staying long 5-year real rates and favors cautiously buying duration on those dips. However, Barclays strategists, they're maintaining a short position on the 10-year because of what they say is still sticky inflation. Meanwhile, massive volatility today in the metals market. That includes the biggest intraday swing in aluminum prices since that $200 peak-to-trough move back in October of 2022. New sanctions from the Biden administration barring delivery of Russian aluminum, copper, and nickel to the LME and the Chicago Mercantile Exchange. While that ban only covers a fraction of the transactions out there, the fear is we could see a significant reduction in Russian flows into some of those more lucrative Western markets. This has put a strong bid under U.S. metal stocks, with Alcoa up as much as 7% today. Century Aluminum is up as much as 9%, and Southern Copper at one point trading above its record high. Now, that news on metals dropped on Friday, just as the market was bracing for an escalation in Iran-Israeli tensions. Now, we headed into the past weekend with the market on edge about geopolitics. Some of those concerns alleviated, but a lot of those concerns still open for question. But for now, Scarlett, the worst-case scenarios have yet to materialize, and that's leading to maybe a little bit of a pause in the safety trade, which we saw last week with everybody rushing into VIX and gold, treasuries, and, of course, into oil itself.
Absolutely. The strong bids into oil, as Romaine just mentioned, driving a leadership change in the stock market. Yes, the equity market's resilience, often credited to big tech, but actually in the past month or so, it's big oil that deserves a shout out. So take a look at the white line. That is XLE, the ETF that tracks energy stocks, up about 15% in 2024 versus a 6.5% gain in the NASDAQ 100 that over the course of today's trading has shrunk to about 5%. Now, investors adding a geopolitical risk premium to the price of oil remain it's anywhere from $5 to $10 at a time when OPEC Plus is keeping supply pretty tight.
Absolutely. Well, we're going to stay on that topic and kick things off to the close here with Greg Brew over at the Eurasia Group, an analyst focusing on the geopolitics of oil and gas. He's the author of Petroleum and Progress in Iran, as well as a relatively new book out along with David Painter called The Struggle for Iran. Greg, great to have you here on the program. I think all of us were on edge heading into the weekend, waiting for that attack. We did see that attack on April 13th, unprecedented to be sure. The first time that we've seen Iran launch missiles towards Israel using its own forces from its own territory here. The big question, though, Greg, everyone wants to know, is that it? Is this over?
Well, absolutely. Thank you so much for having me on. Indeed, an unprecedented attack from Iran against Israel. Hundreds of drones and missiles launched from Iran directly at Israel. But a few things to note, and I think reasons why the market kind of took things in stride when they reopened this morning. First of all, Iran heavily telegraphed this attack. There are coherent reports indicating that Iran notified regional states and also the United States through intermediaries of its plans to attack Israel on Saturday. This gave the United States and other states ample time to put in place air defenses that allowed Israel to shoot down virtually all of Iran's drones and missiles, the result of the attack being relatively little damage to Israel. This attack, as you mentioned, was largely baked in. I think the price of oil had already added a risk premium as we went into the weekend. So it largely met expectations. Right now, concerns are, what will Israel do in response? Well, everyone's waiting for a sign that Israel will retaliate against this attack.
Well, that's what I'm curious about. I mean, we heard from the IDF chief of staff a little bit earlier. I guess he gave a speech at our air base over there, basically making it clear, in his words here, that Israel has no choice right now, Greg, but to retaliate in some fashion. The question is, what does that retaliation look like? Is this going to be one of those minor tit-for-tats where they hit maybe a site in Syria or somewhere else? Or is this a possibility that we could see much more of a direct attack on Iranian territory itself?
That's really the crucial question. I mean, Iran, by retaliating for the Israel attack on its consulate in Damascus, by retaliating directly against Israel, Iran has now moved the threshold for action and placed a great deal of pressure on Israel to respond in a similar way. Now, pressures are coming from the United States as well as other states in the region, pressures on Israel to try to reduce escalatory pressure, to try to keep the Israeli response within the bands of this crisis, to keep it from escalating further. I think we are certain to see an Israeli response. I think that response will come quite soon. Israel has to respond to this direct attack on its own territory. The question of whether it attacks targets within Iran is the crucial one, because Iran has historically had attacks against its own territory as a red line, one that, if crossed, will prompt an immediate and significant response.
So there's Israel's response, and then there's also the U.S.'s response as well, Greg. President Biden has promised a diplomatic response to Iran's attacks. However, since he became president, we know that he's relaxed the enforcement of U.S. sanctions on Iran, which allowed Iran to increase its oil output. What do Biden's options really look like right now, especially given that it's an election year?
Well, I think President Biden is focused first and foremost on trying to get the Israeli response to be calibrated, to be limited, to prevent this from escalating further. I think we've seen consistent action from the administration over the last 6 months to suggest that it does not want escalation in the Middle East, and that includes escalation against Iran. Even though there's been pressure on Biden to try to tighten sanctions enforcement on Iranian oil exports, that oil continues to flow, regardless of the fact that Iran has been supporting its allies, regardless of the fact that Iran supports Hamas. That oil continues to flow. It's largely going to China. I think Biden wants to continue to avoid a situation where he has to clamp down on Iranian oil exports, because that would have an immediate physical impact on oil markets, which of course would reverberate throughout the global market. Also, if Iran feels that its oil exports are being threatened, it could very well escalate against oil flows in the region. That would disrupt oil through the Strait of Hormuz. We would go from 1.5 million barrels of Iranian oil being affected to as many as 20 million barrels being affected. That's the whole supply coming out of the Persian Gulf.
Right. And it's really important to keep in mind that for now, there is no actual oil shortage at the moment. Oil is flowing, as you pointed out. So given all of that, when we think about OPEC Plus, the producers of oil, does it have enough spare production capacity to control a price rally if the worst case scenario does result?
Well, OPEC is sitting on around 3 million barrels a day of spare capacity that it's taken off of the market. That's a pretty decent cushion to absorb an immediate shutdown or a significant disruption. If the disruption becomes huge, like if we start to see a lot of barrels being disrupted, then that would create a pretty significant crisis. But as we've mentioned, I mean, OPEC is sitting in a pretty good position right now. The price is roughly where it wants to be, thanks to this risk premium. It has spare capacity that it can bring back in case of a disruption, but it's also watching fundamentals. I mean, demand growth this year has been a little bit stronger than anticipated. Prices were already starting to climb before we saw a major escalation between Iran and Israel. So I think right now, it's a little early to talk about OPEC bringing supply back on the market. If anything, they're going to sit tight and watch crude continue to rally on the back of these tensions.
All right, Greg, gonna have to leave it there. Greg Brew, Eurasia Group analyst, and we should point out WTI crude, which has spent most of the session in the red, now poking into the green with stocks hitting session lows as we kick you off to the close here on this Monday afternoon. A discussion up ahead about big banks and a big beat for Goldman Sachs. The Wall Street giant recording a 28% jump in net income last quarter. A read on the latest bank results.
Plus, Salesforce, the worst performer in the Dow Jones Industrial Average and S&P 500. On news, the software company maybe dipping its toe back into into M&A. It is our stock of the hour.
And a check on the global supply chain. Greg Hewitt, U.S. CEO of DHL Express, joining the big program in just a second. Stick with us. All that and more coming up in a bit. This is The Close on Bloomberg.
JP Morgan and Wells Fargo kicking off a likely parade of Wall Street's biggest banks tapping the U.S. bond market. Joining us now is Winnie Cisar, Global Head of Strategy over at CreditSights. And Winnie, it's not just the big banks. You have regional lenders also set to sell bonds in the coming days once they've reported their quarterly results. Overall, is bank credit seen as a value play the same way that bank equity is seen as a value play?
I think that a lot of investors are still looking at bank bonds as a pretty attractive place to put capital to work, especially in the corporate credit markets where spreads are objectively tight across the board. But there is still some relative value left in banks, especially for some of those smaller regional lenders, but even for some of the larger banks like Citigroup.
Right, and they're all taking advantage of it right now. You mentioned tight spreads. We've seen a record pace of issuance in the U.S. investment-grade primary market, even as rates are staying higher for longer. Issuers clearly are taking advantage of that tight risk premium, the tightest since 2021. What kind of catalysts do you foresee widening these spreads?
Well, we had initially expected that these elevated rates and the rates market volatility that you were talking about a little bit earlier on the program would start to shake loose spreads. Now, what we probably didn't appreciate as much was the all-in yield environment for corporate credit, especially for investment grade, is still really attractive. We have yields above 5.5% in aggregate, closing in on 6% for triple Bs. And those are levels that investors have not been able to consistently put cash to work in the investment grade market for really quite some time. So that all-in yield level is still very, very compelling. Now, what could shake it loose is some sort of expectation that we're not actually going to get a Fed that is able to start to cut rates at some point this year.
Right.
And that would be especially damaging if it also seems like maybe fundamentals are not as strong as people think they are right now.
How strong is that correlation right now, Winnie, between what we're seeing on the corporate side, spreads there, and the potential moves in actual Fed rates and Treasury rates?
So it's not as strong as we would maybe expect. You know, we have seen a pretty massive repricing of Fed expectations. At the beginning of this year, people were thinking, oh, maybe 5-6 cuts in 2024, bring the policy rate down almost to 4%. Now, maybe 2 cuts, bring the policy rate down closer to 5%. And instead, we've seen spreads quite resilient and kind of hold in a very narrow range close to cyclical tights. So it's been an interesting breakdown in those two market components.
I talk to so many people, Winnie. I keep saying, how attractive things look in the corporate space, particularly on the investment grade side, how cheap, even I've heard that word tossed around here. But there's got to be certain pockets out of there that maybe you might want to avoid, maybe because it's gotten a little bit too stretched. Anything you're seeing there?
Sure. I think that the thing that we're most concerned about is the focus on credit over duration risk. Credit risk has had a tremendous rally. We've seen high yield outperform investment grade pretty materially. Spreads tighten to very tight levels. Triple C credits that are not expected to default are kind of viewed as going concern, trading at very tight levels. And we're a little bit concerned that perhaps the optimism there is a little bit too much. And instead, we do like buying duration at these elevated Treasury yield levels. And when we look at the adjustment in spreads for some of the very deeply discounted bonds, which tend to trade a little bit tighter, that adjustment is less than it was in much of 2023. So duration is definitely looking much more attractive, in our opinion.
All right, Winnie, always great to talk to you. Winnie Cisar there, Global Head of Strategy over at CreditSights. Closer look at what's been going on in the corporate bond market, and that is on the back of those results that we got out of Goldman Sachs. David Solomon getting his mojo back. We're going to recap the Wall Street Bank's blowout first quarter with the CEO there touting the results on this morning's earnings call.
Reflects the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Reddit. A number of analysts starting coverage on the social media company after last month's IPO. Needham analyst Laura Martin given a buy recommendation and a $55 price target, citing the potential of AI. Martin says Reddit has a vast library of human conversations spanning nearly 2 decades, making it the best source to train large language models on how to respond to questions. Those shares nevertheless getting caught up in the downdraft, a 4% drop on the day. Next up, chipmaker Astera Labs also getting a start of coverage today, this after its trading debut in March. A buy rating coming from Jefferies, a price target set at 85, with the analysts calling Astera an AI plus growth story. It has several company-specific drivers, according to the analysts, on top of robust AI server unit growth, creating a path towards more than $1 billion in annual sales. Those shares also moving lower on the day. Let's end on aerospace company Triumph Group, though. An upgrade to neutral from underweight. This over at JP Morgan, which says the outlook for defense stocks actually starting to look attractive. The analysts hailing Triumph's stronger balance sheet, I should say, and a focus on manufacturing and repairs. However, the analyst does see some risk, including from the Boeing 737, where Triumph supplies roughly $300,000 worth of content. The shares moving lower by about 0.7%, and those are some of our top calls. Now, we do want to pivot back to what's been going on in the banking sector as those earnings continue to trickle out. We got Goldman Sachs this morning with a big focus on money management and deal making, leading to a record 28% jump in net income last quarter, even as analysts had braced for a drop from a year ago. Joining us now to dive a little bit deeper into the report is Gerard Cassidy, head of U.S. Bank Equity Strategy at RBC Capital Markets. He has a sector perform rating on the shares of Goldman Sachs. All right, Gerard, this surprised a lot of folks, not just 28% growth, but you talk about some of the individual metrics and an ROI of almost 15%, Gerard, way above what most people were expecting.
No, Romaine, they put up very strong results, and Goldman Sachs really delivered in its core businesses. As we all know, the company has struggled with its consumer banking business. It's exiting many of those businesses. But here, they delivered today what everyone knows Goldman Sachs is capable of doing, which is being very strong in investment banking and trading. The particularly strong number in trading was this fixed income currencies and commodity trading known as FICC. That was unusually strong in the quarter.
I am curious as to what you think has actually happened inside Goldman Sachs over the last year or so to see such a turnaround. Is this just basically about better management, or is there something else going on behind the scenes that we don't know about?
I think it's a combination of factors. The management team is essentially the same. So I don't know if we could say it's better management, but I think management's decisions that they've made over the last couple of years to exit the money-losing consumer businesses, which were a real distraction, I think that's the real change. And so the potential, we don't know for certain. We're outsiders, of course, but the speculation that there was infighting within the company over their expansion into the consumer business is ending as they exit that business. And everybody's focus now is focused on the businesses that they do very well, which again, investment banking and trading, as well as wealth management and asset management.
Well, I'm glad you bring up wealth management because I'm looking at Morgan Stanley shares and they're higher today, even with the overall decline in the equity market. How does Goldman's results set us up for Morgan Stanley's results, given that there's so much more of a focus on wealth management at Morgan Stanley?
Scarlett, it's a good point you're making because it is, the real story at Morgan Stanley under James Gorman's leadership was to broaden and diversify that franchise. And he did it very successfully when he took over back during the financial crisis, and he recently has retired now, and Ted Pick, of course, has taken over. But what's also interesting, Scarlett, is that Charles Schwab put up very strong numbers today, and that's more akin to the E-Trade business of Morgan Stanley. So I think the combination of Goldman's institutional business, which of course Morgan Stanley has, as well as the Charles Schwab business, it bodes well for some decent numbers for Morgan Stanley this quarter.
Got it, got it. So, Gerard, if we take a step back and just consider bank earnings season so far, we've seen banks release some of the reserves for potential loan losses that they had previously set aside. Is this justified? Could this come back to haunt them, do you think?
It really depends on one's outlook for the economy. And if you look at what the Federal Reserve Atlanta did today, based on the retail sales number, they lifted the real GDP number for the first quarter of the growth to close to 3%. So that looks pretty darn good for the economy. And many of the banks last year were factoring in a recession when they set up those reserves. So why you're seeing some releases today is because the reserves were based upon the potential for a weaker economy, and we're not seeing it yet. So there's always the risk of doing it. But right now, the outlook, even though with all the geopolitical risk with what's going on in the Middle East, it still looks like the U.S. has got a healthy and resilient economy.
I am curious, Gerard, as some of these banks try to expand their businesses. Goldman talked a lot about a broader push into private markets, and we've heard similar stories from some of the other major banks. We know J.P. Morgan has been working on this as well. How much, if at all, can that actually be maybe an added tailwind for these companies?
Roman, I think you're onto something, because the banks are kind of in a defensive mode over the last, let's call it 12 to 18 months. Now they appear to be more on the offensive mode when it comes to leverage lending and getting involved in, more opportunities to lend into the private credit markets and be a real competitor to the private credit markets. So I think that's also now possibly a tailwind, as you point out. And I think that's another factor that we all have to consider as the banks go to retake some of the market share that they've lost to the private credit markets.
All right, Gerard, Cassidy, really appreciate your joining us today. Gerard Cassidy over at RBC Capital Markets, giving us a bit of a read here on the banks, especially as most of the big ones have already reported, and we make our way towards the regional banks to report. Romain, so far this week, we're going to see 53% of KRE, the regional bank ETF, report results. So that'll be interesting. Yeah,
I think that's going to be a lot more interesting than the big banks. I mean, the big banks, they're always healthy, right? More or less, right? But the regional banks, particularly coming off of last year, it'll be interesting to see whether they're still seeing that kind of dearth of deposits.
Yeah, absolutely. And how sticky that depositor base is, right? Or if people are just fleeing to go get the 4.67% APY somewhere else.
Yeah, I hope they're still not offering zero or less than 1% like some other banks that shall remain nameless.
Exactly. All right, coming up, we've got consumer demand for online purchases teeing up some growth opportunities for logistics firm DHL. Greg Hewitt, the U.S. CEO of DHL Express, will be joining us in studio. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Scarlett Fu. And we're looking at a... Huh?
You are Scarlett.
I am Scarlett Fu, and I'm here on a down day. I mean, we actually have a day in which the market has direction to the downside, of course.
Not the direction you want, but it was interesting. We had this conversation on Friday about what the market would do after the big sell-off on Friday, whether you would see the dip buyers come in. It looked like that was going to happen the first couple hours of trading, and that's been completely erased. We're basically at session lows.
Yeah, we're basically at session lows, and you can blame the retail sales report for a lot of that, pushing out the idea of a Fed rate cut. Again, let's talk about those March retail sales, because they rose 0.7% from February when unadjusted for inflation, suggesting there's plenty of momentum heading into the second quarter and boding well for U.S. GDP and the companies that ship products for businesses and consumers. We're talking about companies like DHL. So here now in studio to offer his perspective is Greg Hewitt, U.S. CEO of DHL Express. Greg, good to see you.
Good to see you, Scarlett.
So clearly consumers are spending, but the way they're spending is definitely changing. We're kind of downgrading what we're spending, maybe trading down a little bit. Your rivals, FedEx and UPS, are seeing consumers and businesses making a shift to sending mail and packages by ground rather than by air. Are you seeing that too?
I think what we've seen is we've come off of a time period where e-commerce and online buying has been very strong. Strong U.S. dollar. Americans are consuming. We see fast fashion, a lot of stuff coming in to get delivered. Maybe in the traditional segments like automotive, high tech, engineering and manufacturing, we haven't quite seen that momentum in the orders translating into actual shipping in Q1. So I'm hopeful that Q2 and beyond, we will see a bit of a recovery and some growth.
In the meantime, though, FedEx and UPS have cut costs by reducing their workforces. Are you doing anything like that?
I think I'll say I'm blessed that I haven't had to do any major cutbacks in terms of staffing. I've been able to reduce things like overtime and some of the weekend work that's allowed me to not have the pains of having to do major layoffs. But we have seen volume come down, and it is having an impact on our business as well.
As that volume comes down, where's it coming down to? Is that just kind of taking us back to kind of pre-pandemic norms, or are we kind of getting below?
I think we're still well above pre-pandemic. If I look at from 2019, we're well up from there. But certainly we all saw a big boom through the pandemic where you had personal protective equipment, vaccines, and simply lack of capacity that moved all of our volumes up. We're down from those heights, but still well above pre-pandemic levels.
Well, just as we were kind of hopefully putting the pandemic behind us and dealing with all of the supply chain disruptions, we now have new issues, of course. You have the situation in the Middle East, a lot of concerns about boats trying to get through Suez Canal, the Red Sea, and of course you have the drought down in the Panama Canal. Has any of that actually translated into increased business for DHL Express?
Haven't seen it yet, but I think some companies will look to be patient. They'll wait to see how that plays out. The traditional peak for air and ocean is really in the summer months, whereas mine is U.S. Thanksgiving through Chinese New Year. So I think what will happen is if things don't recover, you'll start to see some of that pressure around the summertime, which may mean more business for those of us in the fixed networks in Express come Q3, Q4.
Do you have the capacity to handle that increase?
Yeah, we're in a very good position within our own network, and then we can leverage commercial lift and charters to supplement. And we've shown historically through the pandemic that when big rushes of volume came on, we were able to manage and handle it. I'd expect we'd do the same. I would like to see a bit of a peak again, where that's my challenge, managing the capacity.
Romain was talking about all the snafus in the global shipping networks. What about the collapse of the Baltimore Bridge? Because initially it led to the complete closure of the port of Baltimore, but we've actually seen them open up temporary channels, and it now looks like the port itself will be operational months ahead of schedule. What does that mean for DHL US, Express US?
From the Express side, not a ton. I mean, ultimately that would impact my sister organization on the ocean side more in the immediate. I think the longer term is anytime there are challenges with the supply chain for ocean, that can result in increased air usage later on, closer to the season where actual inventory needs to be delivered to consumers. So I wouldn't see that right away.
But that increase, it's not sticky, is it? Is it a temporary boost because it's just a workaround rather than a permanent shift?
That's very good insights, Gerard. That's the reality. I think when we saw the pandemic boost in our volume and a lot of companies shift to air freight, we wondered if some of that would stay. And the reality is we kept a little bit of it, but most of it shifts back to, I guess, the right mode at the right price point that corresponds to that inventory moving. And that isn't always Express air. So it isn't sticky, it's temporary.
I mean, I know you have to deal with a lot of the day-to-day issues, but at the same time, you've got to strategize. You've got to think long-term. Where's the growth coming from? Like, what type of industries do you see really sort of starting to sort of pick up and show a little bit more presence in this space?
Well, from my standpoint, e-commerce has continued to be the growth engine. That coming out of the pandemic, it didn't slow down. It didn't come down. It kept growing. I think what we're seeing is growth both inbound and outbound. We're seeing a lot of small and mid-sized U.S. businesses marketing their products around the globe, and we're helping them reach markets they didn't have before. And then as people have moved from a China plus one scenario where they're not just relying on China for goods to come in, we've been there to help them open up new lanes, say Vietnam, Sri Lanka, India, or in Mexico.
But how does that nearshoring trend, though, affect you potentially negatively, right? I mean, I understand that if you're just shifting suppliers from China to another Asian nation or to Africa or somewhere else, you still need transport. But as you know, the Biden administration here has made a big deal about trying to do more stuff right here within the U.S. Does that have an effect on you?
It might. Over time, if true protectionist policy came in and everything was being made and distributed in the U.S., I'm an international business, not a domestic one. That would have an impact. But what we've seen is globalization trends. We did a connectedness survey that showed globalization and global trade is still prominent and growing. It just means different lanes shift over time. And being in all countries and all around the world, it really does put us in a good position to help wherever that trade flow shifts.
All right, well, you certainly have your finger on the pulse of what's going on, which is why we like talking to you. Greg, appreciate you stopping by. Greg Hewitt, he's the U.S. CEO of DHL Express. And Scarlett, I mean, we spent, probably most of 2020, 2021, 2022 talking about all the supply chain disruptions. And it's interesting to see that we're still kind of dealing with a lot of the same issues.
Yeah, I was thinking back to the last time I used DHL, and it was because I purchased something from Europe and they had to send it over. I ended up having to return it, and I remember carrying it all over the city. I wish they had one of those, those mobile pop-up stores that they have in other parts of the country. But this being New York, it's not available here.
Yeah, we're always the last to get everything, Scarlett. But don't worry, once we get it, I'm sure we'll.
Such a New Yorker, we're complaining about everything.
Yeah, exactly. That's the New York way. All right, stick with us. A lot more coming up here. A closer look at what's going on in the markets at session lows and some big movers. Salesforce plunging. On the news that it's considering M&A in order to boost its data capabilities, investors thought they were over with that, but apparently not. It's our stock of the hour, and it's up next, right here on The Close on Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
All right, it's time now for our stock of the hour, and we're taking a closer look at Salesforce. Shares down 7%, worst day for the stock in more than a year and a half. This after Mark Benioff's software company is said to be in talks to buy Informatica. It has an enterprise value of more than $12 billion. A Salesforce spokesperson saying the company doesn't comment on rumors and speculation. However, well, investors are, of course, reacting to it. Abigail Doolittle joining us right now for a little bit more on this. And Abigail, the reaction to this seems to be based on the idea that we thought Mark Benioff had sort of found some cost discipline here, that he wasn't going to make these big acquisitions anymore.
That's certainly a piece of it, because last year he did say that the M&A squad there, that it's off, that they are not looking at big deals, Slack being one of the big ones not so long ago. Another piece of it is when the Wall Street Journal initially broke this, they talked about the idea that they would be paying, Salesforce.com would pay for Informatica less than the closing price on Friday. So, of course, nobody's going to like that. Now, to be fair, Informatica over the last year up 150%, Salesforce up 50%, so they do have some capital. But a lot of analysts also just saying this is not a great deal for Salesforce.com. There's not a lot of fundamental reasons for them to do it. Salesforce top line is growing double digits, low double digits, like low double digits. Informatica kind of mid-single digits. They already have a company that does the same thing. It's software and service. I'm not exactly sure what that translates to. But MuleSoft they bought, so they already have it. So a lot of analysts are saying this is a head scratcher. Why did they do this? Now, one reason could be 47% is owned by Permira, a private equity firm. The Canadian pension owns another 26%. Maybe they want out. Maybe that somehow got to Mark Benioff, although that doesn't make sense either, because why would he bow to that pressure?
So how much of is there a linkage to the overall market sentiment? Because you have the S&P 500 down about 1.2%. Earlier, it had opened higher and did gain almost 0.8%. Is the negative sentiment around this potential deal that Salesforce would be making part of the bearish market action?
I think that's a great question. I think it's a good point, because I think that the sentiment around this, it's such a head scratcher for most analysts. There's one analyst out there, Oppenheimer, saying that it makes some sense from like a deal standpoint, but most of the analysts are saying it just makes no sense whatsoever. So I think that when you have a big company like Salesforce, the last time I've looked, I'm going to pull it up in the Bloomberg right now, it was the second biggest drag on the S&P 500. It's not a huge component. That speaks to the level of decline. Well, I'm misspoken now because now we have Microsoft, Apple, NVIDIA in there. But Salesforce is in the top 10. So I think that it helped turn some of the sentiment around tech.
Yeah, and not just in the top 10 too, but I mean, a lot of people do see it as kind of like whatever Salesforce is doing, that's going to have ripple effects throughout the SaaS stocks overall here. So when you start to hear that Benioff is back on the prowl, and again, we should point out, we haven't confirmed, this is just based on reporting that Salesforce hasn't commented on, but if that is the case, then that means some of these other companies are going to have to take a look at their own.
For sure, because it does put the space into play to some degree today. And you also have to wonder why, it goes back to the why, because if they want out for some reason, if they see dark clouds on the horizon, I think that there can be some fear, because it just doesn't make sense from a fundamental standpoint. I think that some investors are thinking that this is about cashing out, which is not necessarily a great reason.
Yeah, all good points. Abigail, thank you so much. And of course, Romain, one thing to consider as well is if there is some kind of deal or bid being made here, this attracts the attention of antitrust regulators as well.
That's the other thing, too. I mean, that's really not been talked about. I mean, Salesforce luckily hasn't gotten it too dinged by that in the past, but as you know, times have changed a lot over the last couple of years.
The big getting bigger is something that plenty of government agencies are looking at very carefully now. All right, coming up, we're going to count you down to the closing bells. We have a decline on our hands here with the S&P 500 bumping around session lows below its 50-day moving average at 50.61. Tony Roth, the CIO over at Wilmington Trust, will be joining us to give us his take on what you do next. This is The Close on Bloomberg.
This is the countdown to the close. I'm Romain Bostic alongside Scarlett Fu. 10 minutes until we get to the closing bell. Scarlett, not just a big sell-off, but actually another broad-based sell-off, if you will. Here, we're off the session lows, but still, we're looking at 1% losses across the board.
And a sharp turnaround from what we saw this morning, because when markets opened, we had the S&P 500 gaining almost 0.9% before turning around completely. Now it's below 5,100, and it's falling below its 50-day moving average, its short-term trend line, and bumping along the bottom here as treasuries continue to sell off as well, with the 2-year getting really close to 5% and the 10-year, of course, moving up to 4.61%.
Yeah, this gets into the big question here, is that what's actually being priced in? And I guess to a certain extent, it's a little bit of everything, whether it's the economic data, whether it's Fed, whether it's geopolitics. We had a chance to catch up with Winnie Cisar a little bit earlier at CreditSights. Here's what she had to say about the yield environment.
So that all-in yield level is still very, very compelling. Now, what could shake it loose is some sort of expectation that we're not actually going to get a Fed that is able to start to cut rates at some point this year. Right. And that would be especially damaging if it also seems like maybe fundamentals are not as strong as people think they are.
All right, for more insight, let's bring in Tony Roth. He's the CIO over at Wilmington Trust, joining us to help count you down to the closing bells. And as we focus on the equity market, Tony, a lot of folks right now are focused on what we're being seen in the Treasury space, and that's resurgence in yields higher here, now sitting some of the highest levels that I guess going back to November or October of last year. Are you buying into that? You think that this is a move that's going to stick?
No, I don't think it's going to stick. Let's start with the equity market. We haven't seen a real correction in the equity market in over a year. And we have an opportunity now to see a catalyst for a drawdown in equities to bring us to a little bit healthier territory, probably back down below 5,000 on the S&P, which we believe is going to be a buying opportunity. And the reason is that the higher yields that we're seeing and the equity markets following onto that with weakness in technology, which typically does not respond well, does not correlate well with higher yields, is all being driven by the narrative of, yes, strong economy, but also much stronger inflation than expected. In fact, when you look at the core PCE, which is the Fed's preferred measure, we are already on a 12-month basis in the range that the Fed has predicted for the end of this year, around 3.5%. Mm-hmm. And so when you look at CPI, which is heavily dominated by shelter is coming down. It comes down every month to lower levels of price increases by around 15 to 20 basis points per month. It's just going to take a while to get to the destination on a CPI basis. But later this month, we'll get the CPE numbers, and those numbers will be, I think, a little bit more constructive for a loosening cycle starting, we still believe, starting in June, with a total of 100 to 125 basis points of cuts this year. And so the market's really reacting to a very short-term narrative.
Tony, so 100 to 125 basis points this year, starting in June. I mean, you know that's a pretty bold call, not just because of the number of cuts that would entail, but also the fact that they would be doing that in a relatively short span, 6 months, and in the middle of an election cycle.
Well, the cuts don't have to be consecutive in the sense that once they start to move, they can make cuts bigger than 25 basis points, of course. But we still have two major sets of data to come in before we have the June meeting. So whether we start in June or whether we start in July, once we start in earnest, there's plenty of time to get in the 100 to 125 basis points of cuts this year. And when you consider that inflation is being driven primarily by premiums on automobiles and shelter within the CPI, and then you move over to the PCE, you don't have nearly the same impact on shelter. Medicare costs came down, in fact, on an inflation basis over the last cycle on a CPI basis. It's all shaping up for, I think, a compelling case to start cutting sometime over the summer.
You said that it doesn't have to be consecutive 25 basis point cuts, but wouldn't a half point cut be something fairly alarming for an equity market that has priced in a no landing scenario?
No, not necessarily. If you look historically, when we have inflection points in monetary policy, whether it be a loosening or a tightening cycle, we almost never get consistent 25-point cuts. We start at 25-point cuts or increases, as the case may be, and then once the Fed realizes they fall behind the curve, they move to bigger increments for a period of time. That's almost always what happens, again, whether it be a tightening or a loosening cycle. And so the key is that if we continue to see strong, for equity investors, if we continue to see strong momentum in the economy, we don't even necessarily need to see a big change in the inflation picture from the market standpoint in order for equities to continue to do well. The question around inflation and whether the Fed starts to cut in June and how much the Fed cuts is really more of a positioning question within equities, whether you like a broadening out narrative and smaller caps, or whether you like to continue to see the focus on technology and bigger companies.
Okay, so in your scenario, rate cuts starting in June, maybe 100 or 125 basis points of cuts, where do you want to be within equities, given how much the big cap tech names have moved up over the past couple of years?
Well, we still believe in big cap tech as fundamental rails of the economy. So we want to be selective within that area. The companies that are more focused on AI and cloud and SaaS, et cetera, are the ones that are going to do better than the ones that are focused on delivering hardware. But having said that, you also want to move into names that will give exposure to a broadening cycle from both a cap and from a sector standpoint. So certainly you'd want to move into small cap names, which continue to lag, which continue to get set up for a rebound, I think, once you start to see that loosening cycle, as well as financials. Bank stocks you saw this year, part of this cycle, you saw part of as the earnings get kicked off. You saw JP Morgan come out late last week with a very, very small miss in their forward-looking estimate on guidance for net interest income, which sent the stock down considerably, really without justification when you look at the bottom line. And so that's an area, whether it be the major money center banks or whether it be the regional banks, that should do well in a broadening cycle, as well as healthcare, as well as industrials, as well as materials. So there's quite a few areas that I think that are positioned for a rebound trade, in addition to keeping that market weight on some of those core big cap tech names.
All right, Tony, great stuff as always. Tony Roth, CIO over at Wilmington Trust, helping us count you down to those closing bells. We're just about 3 minutes away from that. Scarlett here, 4.92 right now on a 2-year yield, 4.6 on the 10-year yield. And as far as stocks go, we're still down in the red.
Yeah, we're still down in the red, near session lows. The big question is, will the next batch of earnings change anything, change the trajectory as we await some kind of response from Israel following the weekend attacks from Iran?
Yeah, you wonder how much of the move today is because of earnings or because of the Fed and rates or because of Israel and the geopolitical situation.
Yeah, or just wait and see until something more definitive comes along.
And this could be a pivotal week for earnings because it's not just the banks. Of course, we're going to start to get the non-banks, including Netflix, which could be a big barometer for the broader tech sector as we move move closer to those closing bells here on this Monday afternoon. Stick with us as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Carol, stocks off session lows, but still, we're talking about 80% of the S&P right now deep in the red.
Yeah, broad-based selling, right? No doubt about it. So a very different tone here. And it has to, I just keep looking at the rates market and where that 10-year, above 4.6, holding there. Again, it makes me think, Tim, okay, do, equity investors have to once again rethink valuations in a higher for longer and getting higher, it feels like, when it comes to the Treasury trade?
Well, we just spoke to Ryan Dietrich over at the Carson Group. And you guys know him. I mean, he called it last year. He got it right last year, Scarlett. He's still extremely bullish. And he said, okay, he called what we're seeing right now, quote unquote, indigestion in the market. And that, some type of pullback, 5 to 8%, given the run up that we've seen since October, would not at all be surprising. But if this economy avoids a recession, which he thinks it will, then he stays bullish.
Indigestion is a kind way of putting it, given how big the losses are today. What's interesting here, of course, is that we thought we saw most of the selling on Friday, given there was so much anticipation of some kind of attack over the weekend. We got it, and there was a little bit of a relief initially, but that didn't hold. So, I mean, how much are we going to be on tenterhooks for the rest of the week? Because there might be a response from Israel, but then how does Iran respond to that? I feel like we're just going to be in this churn for a while.
Yeah, and we should point out, too, I mean, when you sort of pair this with the decline that we had on Friday here, I mean, this is the biggest two-day drop that we've seen in the markets going back to late October, at least for the NASDAQ and the S&P here. So I think that's maybe a little bit different complexion than maybe some of the other sell-offs we've seen where we kind of had a one and done and then everybody's back in the pool. Not today with the Dow Jones Industrial Average lower by about 250 points or about 0.7%. The S&P going to fall about 62 points roughly, down about 1.2% and back below 5,100, 5,061 and change as we wait for these numbers to settle. The NASDAQ Composite lower by about 290 points or 1.8%. And let's take a look at the Russell 2000. The cyclicals down about 1.4% here on the day, down 27 points.
Right, and the S&P 500 really breaking below its 50-day moving average. Our Bill Maloney, who watches the technicals here at Bloomberg, saying that was significant. He was watching it Friday. It held Friday going into the weekend, but that's not the case today. Having said that, Scarlett, as Romaine mentioned, most names in the S&P 500 lower today, 424 to the downside, and you had about 76 gaining some ground today.
Yeah, I was just looking at the VIX. It shot up to past 19 from 17 on Friday. So we're now at the highest level since last October when we had the last big sell-off. You're looking there at the IMAP, and when you break down the S&P 500 into 11 industry groups, all red all around, tech, real estate investment trust, and communication services leading the way. The sectors that are doing fairly better or holding up a little bit better here are telecom services, household and personal products, and banks, but just marginally so.
All right. And just before you move on to the individual movers, I just want to point out, I was looking it up. So the S&P on a two-day basis, this is the worst drop going back to March of 2023 in the middle of the regional bank crisis. The NASDAQ, worst two-day drop going back to October of last year.
All right, so some significance, right, in terms of what we've seen in a couple of days and that tone and tenor in the S&P 500 and particularly the equity market. Having said that, was able to find a few gainers in today's session. Goldman Sachs, of course, out with earnings earlier today at its highs, up 6%, folks, finishing the day just shy of a 3% gain. Really a standout among the big banks that have reported so far. Goldman, by the way, shares were the number 2 gainer in the S&P 500. Profits soaring 28%. You probably know this, bucking analyst expectations of a drop. Fixed income traders surpassing even most optimistic estimates. And we did get some upbeat comments about AI. David Solomon, the head of Goldman, saying it expects significant demand from AI-related infrastructure and as a result, financing, which will be a tailwind to their business in particular. All right, number 2 gainer in the S&P 500, another bank, and we're talking about M&T Bank soaring the most in, I believe, 2 years after boosting boosting its 2024 outlook for net interest income. Of course, a key source of revenue. That's what we look at when it comes to these banks. So M&T Bank up almost 5%, 4.7%. It was up, though, 8% at its highs today, so finishing off its best levels of the day. Intel, looking at the chips today, we did see a lot of chip names, your top gainers in the NASDAQ 100. Intel, the number one gainer in the NASDAQ 100. Citi opening up a 30-day positive catalyst watch on the stock, saying Intel is experiencing negative sentiment due to the foundry businesses. We reported about this at Bloomberg in the last week or so, but that given the positive March notebook data of a 44% month-over-month increase, there's upside to consensus estimates. So getting a little bit in the weeds, but nonetheless, they're upbeat. Citigroup, that is, on Intel. So that stock easily a standout in today's session.
Okay, you had the hard job today, Carol. I had the easy job finding decliners. Quite a few notable ones, including Tesla, finishing down by 5.6%. This after Bloomberg reported that several top executives are going to be leaving the company, and there will be global job cuts at the company. In fact, the largest ever round of job cuts, reducing global headcount by more than 10%. Our team actually reporting that the cuts could reach closer to 20% in some divisions. Two people familiar with the matter told our own Dana Hull and Ed Ludlow earlier today. In addition, Senior Vice President Drew Baglino, who's an 18-year veteran of the company, just one of four named executives at the company, four named executive officers at the company, I should say, he announced today that he was leaving. Shares hitting the lowest since May of last year. Also falling today on a percentage basis, the worst performer in the S&P 500 goes to Salesforce, down the most since going back to December 2022. This after Bloomberg reported the company is targeting Informatica to boost data capability. That's according to several people familiar with the matter. Some analysts, though, noted that such a deal may draw regulatory scrutiny. Should note that Informatica shares also fell today by 6%, that a software company. And DJT, Trump Media and Technology, ticker DJT. Of course, Donald Trump's social media startup tumbling again today, this time falling close to 20% on the day today. This after the company took a first step toward allowing the former president and other insiders to capitalize on their stake. The company filed to register shares, including those linked to warrants, and that could ultimately bring forward sales from insiders that are not currently permitted until September. Read, perhaps President Trump. We should note that now former President Trump's net worth, is at least tied to this, has fallen from more than $5 billion to just over $2.1 billion in a few weeks.
And I just want to point out a couple other big decliners, Ted. Tim, I'm sure you saw it with all of the crypto stocks moving lower. Bitcoin now back down below that 64,000.
Did you see
level.
crypto over the weekend, Romaine?
I'm just going to surprise you, Tim, but I actually don't sit up over the weekend looking at crypto. But what happened?
Well, given, it's people thought it was a hedge against, what could happen around the world. Yeah. And it ended up falling to 62,000 Bitcoin over the weekend on the strike from Iran.
Yeah, on the week of the halving. I was told the halving was everything. Anyway, let's take a quick look at what happened in the yield space, because that really was where a lot of the volatility was today here. You're looking at a 10-year yield right now back at that 4.6 range, up about 9 basis points on the day. The 2-year yield, a smaller move, but nevertheless, at one point, it was just a tick or two away from hitting 5. Remember, it was just back in early February, we were looking at a 10-year below 4 and a 2-year yield back in mid-January that looked like it was also going to break below 4. So a huge reversal from where we were at the start of this year when everybody thought the trajectory for yields was lower, lower, lower. People were going long duration, but the sell-off, guys, now continuing here for what would be a fourth straight week.
All right, so that's significant, right? We care about these trend lines and what we see from week to week, so really important. Having said that, a little bit of, levity. I will say this is one of the most read stories on the Bloomberg terminal. It's a Bloomberg opinion piece, and then the headline on it is why everyone in finance is getting ripped. It gets into a Goldman Sachs banker over in London. He's 55 years old. He's got his own podcast. He goes by G-Dog, but it just talks about how we are seeing a lot of bankers who spend a lot of time doing their job, how they are now kind of branching out, looking to spend a little bit more time on their wellness. And you see top-notch fitness facilities at some of the banks that are around the world. And so...
Well, that's an understatement. Did you see the pictures of that gym that they have at Goldman? And I was like, I was a little envious.
I'm
still
we
looking
don't even have a gym here.
It's pretty fancy.
I'm still looking for the gym.
I just got to roam around.
You just want to be called our dog, don't you?
It'd be nice to have a cool nickname, but
it could happen.
But it's interesting too, in all seriousness, of that story.
Yeah.
There's been other stories that kind of written about this, how just the tone of just how things work on Wall Street, that the idea of taking people out for drinks and other things that were kind of commonplace has now shifted to more wellness activities, going for a run or taking people to the gym.
Or training with
or
clients
somewhere.
rather than going out for a martini.
And that's because
or
a lot of
something.
clients want that.
Yeah.
Well, it's a recognition that perhaps drinking and going to unsavory places is no longer the way of the street, and you can do other
What
things.
What do you mean
and
by unsavory?
Well,
Scarlett.
I mean, one part of the story that I really liked here is the idea that, you could have associates, just out of college, or perhaps even, folks who are interns working out next to managing directors, or perhaps showing them,
interaction.
how to do certain things. Do you even lift, bro?
Me?
No, I'm just like,
Oh.
are they saying
Oh,
that
wait,
in the
was that
gym?
for me or Scarlett? I'm a little confused here.
Yeah, I don't know. We don't know who Tim was trying to diss there.
I don't call Carol bro.
We should point out, Tim's probably the fittest guy on the show. So, I know all your client visits are probably, on the Peloton or something, right?
Yeah, I don't know.
All right.
Tim,
We don't
Tim's
have a
a big
gym.
I mean,
cyclist.
when Tim
Still
started
looking
here, he
for
it.
invited me over. And
Bros,
he said, "You wanna
it's a
ride?"
wrap,
I was like, "No,
apparently.
I don't."
Bro. All right, guys, that'll do for our cross-platform
All right,
coverage.
No.
Radio, TV, YouTube, Bloomberg Originals, our family. We'll see you again, same time, same place tomorrow.
Stick with us here on The Close. Bloomberg Television coverage continues with a closer look at those reports about Apple iPhone shipments apparently falling 10% in the March quarter, making it the worst sales slump since COVID. We're going to bring you the details, and we're going to show you the link with China. That's coming up next on The Close. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. And Scarlett, it looked like early in the session we were actually going to have one of those big buy the dip moments coming off of that 1.5% decline in the S&P last week, but that was not the case here. The news flow was just a bit too broad. Concerns about the unresolved situation in the Middle East, concerns about a relatively hot retail sales report, and of course overall concerns about earnings as well. A 1.2% decline on the S&P 500, a two-day decline now that logs the worst two-day drop that we've seen for the S&P going back to March of last year. The yield story was where a lot of the volatility was. In fact, some of the biggest volatility we've seen in that space in about a year here, and a tons of volatility in the metal space. Aluminum prices only ended the day up by about 3% here, but the intraday swings that we saw, we haven't seen that in more than a year and a half. That was on the back of concerns here about the new sanctions. Now, there were some bright spots out there, Scarlett, and you can actually find that at the bottom of the screen here. An S&P banking sector up 1.8% on the day. What gives?
Big reason for that is Goldman Sachs gaining as much as 6% on the session. Today, it did close up by 2.9%. Chris Kotowski, an analyst over at Oppenheimer, called the latest results a near perfect print. Net profit rising 28% year over year. And for most of the profit and loss lines, meaningful beats on those businesses. So Goldman Sachs up almost 3%. Morgan Stanley and Bank of America are up next. Now, in terms of a big decliner, I'm paying attention to Salesforce.com, down 7.25%, the worst performer in the Dow and the S&P 500. The software company reportedly in talks to buy Informatica, which is exactly the kind of strategy that led to pressure from activist investors. Bloomberg intelligence analysts say that a deal could attract regulators' attention, and not in a good way necessarily, and it could speed up consolidation in the software as a service space overall. Now, our top story this hour is investors bracing for a flood of China economic data, from monthly retail sales to industrial production. But the big report to watch for will be first quarter GDP and what it means for how Beijing moves forward with efforts to boost domestic demand. Romaine?
Yeah, absolutely. And we talk about this idea of how that ties in to all of the companies worldwide, particularly those here in the U.S. And one big one, and that's Apple. Shipments of iPhones, we're learning, slid even more than expected in the first quarter. That's despite a broader industry rebound in smartphones. Now, Apple has been struggling to sustain sales, specifically in China, with the rise of competition from competitors like Huawei and Xiaomi. Bloomberg's Mark Gurman joining us right now for a little bit more on this. And Mark, this is the parlor game. We do this every quarter. Everyone's looking at those iPhone shipments, trying to really calculate just what we're going to learn when that earnings report comes out. What do we know so far?
Yeah, it's interesting. These numbers are coming out around 3 weeks ahead of Apple's earnings on May 2nd, when we'll actually get the nitty-gritty, the details in terms of revenue, not unit shipments on the iPhone. But this data from IDC, it's not typically exactly on the money, but directionally it's usually pretty accurate. And so you're probably going to see another slump. Apple guided that revenue would be down about $5 billion on an annual basis for this current quarter as well, right? So clearly they have that built in to the expectation. A lot of that has already been built into the share price, unless some investors forgot about that. But the larger theme with Apple, for me, is still these existential questions it's dealing with. China on a larger scale. What is their next big market after China? Is it Africa? Is it Eastern Europe? Is it in Southeast Asia, where Tim Cook happens to be right now? He's in Vietnam. He'll be heading to Malaysia, in Singapore as well on this trip. There's a new Apple store opening sometime soon in Malaysia. What's the next big product for Apple? What comes after the iPhone? iPhone sales are falling again. What's going to make up for that lost ground? The Apple Watch, that was a cool thing for some time. That was a top seller, but that's sort of plateaued. So there's so many questions surrounding Apple right now. I think it goes well beyond these iPhone numbers.
I really like the way you put it, existential questions. And you mentioned a bunch of markets, but none of them will ever make up for China, even if you string them all together, right? I mean, that's why there's so much hope pinned on a market like India. Is part of the problem, Mark, that the latest iPhone iterations just aren't that exciting? They don't offer anything new.
Well, yeah. I mean, they offer some things new, but you're not talking about...
the guts are a little bit better, but, you know, do you really need a better camera when your camera's really pretty good already?
Yeah, there hasn't been a hugely significant iPhone revamp since they went to 5G in 2020. And you can argue even the iPhone 10 in 2017 was really the last time they substantially shook things up, right? So it's been a while. What have they been working on all this time? It's the Vision Pro, and that's not going to do anything for sales probably for 5 years, if ever, right? Nobody's talking about it right now. In fact, Apple has made the Vision Pro the front of its homepage, right? And that's always a good indicator of something they're trying to push harder. And we all know why they're trying to push it harder, because people aren't buying it, perhaps in the numbers that they anticipated, or maybe their forecasts were spot on, but maybe they're not great in terms of what it could do for the bottom line.
Yeah, Mark. They did. They redesigned that whole Apple store here in New York to actually put that logo up over there instead of the normal Apple thing. And you know what? I still haven't bought one. Mark Gurman, of course, who covered all of this for us here at Bloomberg. A closer look at Apple and now some of its shipments and maybe what we hear from them when they report earnings in a few weeks. Meanwhile, there is a big focus on China and the Chinese consumer, with that country set to release a slew of data overnight, including first quarter nominal GDP. Now, it's likely to not going to be as sharp a slowdown as initially expected. And it comes at a time when the German Chancellor Olaf Scholz is over there visiting Beijing. For more insights on what to expect, Michael Hirson joining us. He's head of China research at 22V Research. So this is one of those big data dumps that we get: industrial production, GDP, credit growth, housing, labor. All I want to know is really about the consumer over there, the domestic consumer here. Everything I've heard is they're tightening their purse strings, they're being thrifty, they aren't buying anything.
That's correct. And they're not buying really for two main reasons. One is that the property sector has yet to bottom out. And the other is that this is a pretty weak job market in China. The manufacturing sector is growing pretty well, but advanced manufacturing especially doesn't generate many jobs. The service sector not doing as well. So I think that is absolutely the thing to watch, is what's going on with employment, what's going on with the household sector.
What's happening now? Is this just kind of that normal sort of ebb and flow that you get with economies, or is there something structurally changing within the Chinese economy?
I think it's both. I think there's some cyclical things happening, but I think there's a lot structural. The real estate sector is never going to come back in quite the same way. And we've had this continued scarring effect from COVID that the consumer really hasn't come back from. Households didn't get stimulus checks during the pandemic, and they remain quite cautious. And I think this is really seeping into consumer psychology in some interesting ways.
I mean, we got stimulus checks and we ended up with 9% inflation.
That's right.
And because of that lack of stimulus checks, China didn't get the inflation that most of the Western world had seen. So one thing that we know China has focused on is to manufacture more of its own high technology, AI chips, for instance. Why is that not trickling down into the rest of the economy?
I think for a few reasons. One is, as mentioned, doesn't generate a lot of jobs, right? If you look at these advanced factories, there's just not that many demand for workers. The other reason is that a lot of this is being fueled by stimulus, by credit, rather than end demand. So factories are pumping out these high quality goods, but if there's no demand there in the end, what we're left with is concerns about excess capacity and deflation in China. It's not good for the global economy, and it's not great for China's economy either.
And that's exactly what Janet Yellen said when she was in Beijing last week. So when it comes to this first quarter GDP report, the consensus is for us to see 4.8% growth in the first quarter. If the number comes in better than that, and these things are very carefully managed, so it may very well do that, is it going to be seen as good news?
I think for exactly the reasons that you discussed, I'm a little worried that if it's a positive print in terms of the headline numbers, that's a message to China's leadership. We don't need to do more. We don't need to do a lot to boost demand. And officials within the system are going to have a harder argument to make about switching the stimulus strategy to be more focused on consumers. So this could be one of those occasions where strong headline numbers are actually negative for investors because it will relax that urgency on the part of China's leadership to give a stronger demand push.
I want to get your insights, Michael, into what's going on with China's relationship with the rest of the world. Of course, there was a lot of hay made over Janet Yellen's visit over there. We mentioned Olaf Scholz of Germany also making a trip to Beijing here. I mean, what are we trying to do here? I mean, are we really trying to improve that relationship from an economic perspective, or is this just basically, I don't know, just trying to keep our enemy close?
I think there's a mix of the competition and industrial policy, and then on the part of an official like Janet Yellen, also just worried about global growth, right? And the excess capacity issue in China kind of touches both issues. It's making it harder, this excess capacity in sectors like electric vehicles, for the U.S. to develop its own sector here and reduce dependencies on China, but it's also an issue of global growth. We've seen China's manufacturing trade surplus rise to new heights. And so this is why these issues are so contentious. They're industrial policy issues, they're also global macro issues, and they're really embedded in China's political economy and the structure of the economy.
Yeah, a lot to untangle there. Michael, really appreciate your joining us. Michael Hirson of 22V Research. And of course, China is slated to release a whole bunch of economic data reports from GDP to industrial production to retail sales. Now, coming up, we're going to give you the top three movers and shakers at the center of the day's biggest stories. They involve companies like Tesla and Goldman Sachs. This is The Close on Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have take two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is David Solomon. Basically, how Goldman Sachs' first quarter earnings helped the CEO get his groove back. Analysts called the results a near perfect print. Almost all the different categories performing meaningfully better than expected.
Yeah, I thought this was interesting because we've been talking so much about all the drama going on behind the scenes, and of course,
2023.
the poor performance not only of the stock but of the company as well. And we asked Gerard Cassidy this earlier. I mean, like, what changed? I mean, it's still the same management team, so maybe it's just they have fewer distractions. And David Solomon, as he said, we're getting back to what do you say, the basics or something, the core
competencies, their strengths.
So that's good. I mean, hopefully, this is more than just one quarter, and he can put together a string of these things. But it was impressive. I mean, not only in the total jump in net income, but also you saw that ROI. I mean, it's 15% versus what they had last year, the quarter, what was it, like 7.5%?
Yeah.
Something great.
28% jump in net profit is nothing to sniff at.
I've been keeping an eye on a big Tesla executive who is no longer a Tesla executive, Drew Bacalino. We're learning he's going to leave the company, this after 18 years. Now, he's listed as senior vice president, but that kind of doesn't really do him justice. He was pretty integral to the core management team, executive management team there. Remember, this is a very small management team. We're talking basically 4 to 5 people in addition to Elon Musk that are basically running this show. He's gone, head of public policy gone. And of course, that all came against the backdrop of a broader announcement that they're cutting about 10% of the global.
Yeah, so you wonder what's going to happen with Tesla here. And, you know, while I was reading these headlines, I was thinking of what happened at X, or formerly Twitter, and how large swaths of the management team disappeared after Elon Musk took over. And
except X is just a dumb social media site. Tesla's a car company. You can only get rid of so many people.
Exactly. Well said. By the way, Elon Musk runs 6 companies. Tesla, X, SpaceX, Boring, and 2 other. Maybe the Neuralink is a company of its own.
I've lost track.
Yeah, it's a lot of companies. Anyway. The third person we're watching is Scottie Scheffler, winning a 4-shot victory over Ludwig Aberg at the 88th Masters Golf Tournament over the weekend. And in case anyone's wondering, Tiger Woods finished last of the players who made the cut. But one thing I didn't realize about Scottie Scheffler until I watched the videos was he has a really interesting swing.
Yeah, I mean, that's all anybody talks about, and it works for him. I mean, I guess I'll just admit this. I've tried it myself.
And?
It did not work any better than my already bad swing. So I think I'll just stick with the basics. I mean, his swing is very unorthodox. Basically, he lifts up that back foot, which you're always told never to do. But, you know, he is, I think, the most accurate hitter on the tour right now.
It defies the physics of golf.
Yeah, absolutely. But congratulations to him. It was a brutal Sunday. We had only 8 people even finish below par. And so he really just blew everybody out the water. What was he, -11? And of course, poor Tiger was like +16 or something.
Well, he made the cut.
All right, when we come back, we're going to take a look back in history and the history of tax day. Stick with us. This is Bloomberg. Welcome back. For most Americans, midnight tonight is the deadline to file your federal taxes. It's a tradition that goes back more than 100 years with the enactment of the 16th Amendment back in 1913. Now, before that, the only individual income tax that existed in the U.S. was actually put in place in 1861 to help ease the financial burden of the Civil War. It started with a flat tax, 3% tax on all incomes over $800. That's the equivalent of around $25,000 today. But that was later modified to include a graduated tax. It was wildly unpopular, as you can imagine, and the federal government didn't even really have the infrastructure to enforce and collect those payments. So Congress repealed the tax in 1872. But the concept didn't disappear. Following a series of legal battles, including multiple Supreme Court decisions, a permanent tax policy was implemented in 1913, with individuals given until March 1st to file. But like most things related to government taxation, there were so many exemptions, deductions, and loopholes that less than 1% of the population ended up having to pay anything. And for those folks that did pay, that barely amounted to 1% of their income. And that brings us to our question of the day. In what year did April 15th become the official tax day? The answer, 1955. The March 1st deadline did work for a while since so few people in the U.S. met the threshold to file. But as the tax law expanded to more people and became more complex, Congress realized people needed more time to complete their returns. The deadline was pushed back to March 15th in 1919, but Congress had to revisit the issue once again in 1954 for similar reasons. This time, they completely overhauled the Internal Revenue Code and starting in 1955, gave individuals until April 15th to file. Now, the primary goal was to increase the filing rate, and it worked. According to the IRS, about 90% of taxpayers are able to file their returns on time. Through April 6th of this year, the IRS has already processed more than 100 million returns, and millions more will be sent today. But if you're fortunate enough to live in Maine or Massachusetts, guess what? You get 2 extra days to file until April 17th because of a weird quirk. Patriots Day is a holiday in both of those states on April 15th, and you combine that with a separate holiday on April 16th, Emancipation Day in the District of Columbia, which effectively shuts down the federal government, and that's how you get those 2 extra days. And for those of you out there who do need an extension, you're not alone. The IRS estimates at least 19 million of you are going to request an automatic extension by the end of tonight.
I'm just curious about those people who filed before April 10th. That's wow. They've got their books in order because I can't get my act together. And I know, Romain,
I know of no of those people.
Okay. And you were also struggling with the April 15th deadline.
I was up all last night.
There you go.
Yeah.
All right, let's move on to earnings because Goldman Sachs CEO David Solomon says he feels very good about what he considers an above-average quarter. He shared his thoughts this morning on the earnings call.
We feel very good about our first quarter results, which reflect the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
Let's recap the results with Allison Williams, Bloomberg Intelligence senior analyst covering global investment banks and asset managers. Allison, fantastic to see you. Thank you for joining us. We were talking about this earlier, Romain and I, about Goldman Sachs' knockout first quarter earnings report. How much of this is Goldman changing up what it did versus just doing what it normally does, but better this time?
I think they're emerging from a year of transition, right? So going back to the focus on their core units and really those core units delivering in this quarter. So last year we saw a lot of the cleanup as they retrenched from some consumer efforts, some other initiatives. They sold some businesses. We had one sale close in the first quarter, but most of those financial impacts have been felt. We also had sizable commercial real estate impairment charges last year that really added to the cost side of things. So really a tough transition year last year. This quarter in the institutional business really delivering on their strategy. So two of the things that they've said they wanted to do in trading, increase the financing revenue, focus on positioning with top clients, and really that 10% growth coming through in trading both in FICC and in equities compared with a strong year ago. So really delivering on the results and the record prime balances on average certainly were a help there.
So you think that what we saw for the first quarter, Allison, we're going to see that replicated going forward? This is not just sort of a one-off?
So I think that the first quarter tends to be the seasonally strongest. So I would not expect that we see, things remain at this level, but we do think that trading remains within a historically high range. So some moderation in the second quarter in line with seasonal trends, but likely, sort of keeping pace with the year ago levels on the trading front. The investment banking fee front is the more interesting line this year, and we really did see a strong start in debt fees across all the banks. But for JP Morgan and Citi, really that investment grade issuance coming through for Goldman Sachs, the leverage lending. So on the investment grade side, there is some thought that some of the refinancing needs could have been pulled forward. Goldman Sachs, however, thinks that there's momentum in the leverage lending business. IPOs, as you know, we've been talking about that for weeks. The volumes have improved, but there's still huge room to run. I mean, we're still so far below the strength that we saw in 2021, for example, where we saw the record volumes. But both Goldman and JP Morgan saying that some of the performance that we've seen from the recent IPOs could be a positive, notwithstanding some of the action we've seen in markets to start this quarter.
All right, Allison Williams of Bloomberg Intelligence there. We had a lot of earnings out of the big banks today that included Goldman, included names like M&T, it included Schwab, and that continues tomorrow with Bank of America, PNC, and Morgan Stanley. Devin Ryan joining us right now, senior research analyst at Citizens JMP. He does have a market perform rating on shares of Morgan Stanley. And I want to start with Morgan Stanley just because I feel like this is going to be a bit of an outlier from what we've seen with the other banks. Obviously, their core business and everything else might track. But of course, with the news about the investigation into the wealth management business, what are you expecting to hear tomorrow morning?
Yeah, so I think there's a lot of moving parts at Morgan Stanley. So first off, all the capital markets that we're seeing thus far have been quite strong, I think, as Allison just talked about for the first quarter. And I think you're going to see that at Morgan Stanley, too. I think they're going to have a pretty good trading quarter. And so that's our expectation. Investment banking, we are the front end of a recovery there with I think, positive commentary likely on the call tomorrow. And then the flip side is, the wealth management business has been such a tailwind for them over the past couple of years. And when you drill into that, obviously markets being up has been beneficial, but the other part of it is interest rates moving higher has been a big tailwind for them. And so if you have a view that interest rates are starting to stabilize, or even if you believe the current expectations around Fed funds, that there's going to be actually a little bit of a headwind to net interest income. So I think Morgan Stanley, that's kind of the beauty of their business model. There's these natural hedges, but they don't have kind of that pure play on a capital markets recovery like a Goldman Sachs we saw today. So I think results tomorrow will be good, but then the story going forward is a little bit more mixed just because of kind of some of the puts and takes there.
And then you have a name like Bank of America, which is a lot more focused on the consumer. What do you expect there, particularly given that from what we heard out of Wells Fargo and a couple other banks that also have much more of a consumer-facing presence, there was some softness there?
Yeah, I think consumer you have to look at in all the different buckets, right? So the very kind of low end of the consumer, I think is having a harder time here. The high end of the consumer is assets are up overall, and so they're performing quite well. Consumer generally is still strong. I think the big question marks are really around what does this all look like in a year, and then that becomes a little bit of a crystal ball on the economy. But consumers hanging in, and I think thus far through bank earnings, we're seeing some pretty nice results there. So it's really about today versus could things deteriorate a little bit, but thus far the commentary has been encouraging.
I'm curious about deposits because JP Morgan said on its earnings call the industry has something like $900 billion of deposits paying effectively zero. First of all, why do banks still have such large amounts of non-interest-bearing account balances?
Yeah, there's a number of reasons. Great question. I think JP Morgan probably had a little bit of a negative comment on there's still some repricing on deposits to go here. But if you think about the deposits, you have both consumer and commercial deposits. People have deposits that are low price, but they're just working capital for them as a person or as a company, and they're moving that money around frequently. They're not expecting a high rate on it, so it's not necessarily yield seeking. So there's always that transactional piece. It might be a small dollar amount, and so therefore you don't need to get paid a high rate on it. It's not worth it to move it around. And so banks obviously look at that in terms of the different buckets. But really, I think the view is that there could be still at these types of interest rates some repricing left to go here, and I think that's what JP Morgan was cautioning. If you look at firms like Schwab or wealth management firms, they have deposits as well. In our opinion, we're further into the repricing cycle on those. The transactional deposits that are remaining, in our opinion, probably aren't going to move that much. And if anything, they may start to grow again, because what happens is when you bring in new customers and those customers have new assets, that brings in $1 cash that can help replace if there's a yield seeking, if somebody, say, moves money to a money market fund, as an example.
So the new accounts coming in tend to be pretty sticky.
Absolutely. And just the view is that the wealth management firms have already kind of gone through this, and the wealth management deposit money, what's driving that is a little bit different than at the bank side.
Gotcha.
So when we get through this banking season, and particularly we still have to get the regional banks, and I think everyone's still kind of on edge about what their deposits look like. Do we get to a stage of normalization? Like this idea of whatever we went through last year with the regional banks and all the stuff that the big banks were dealing with coming out of the pandemic, are we back or getting close back to normal?
We are normalizing, and credit's normalizing slowly, but it's actually, these have all been kind of upside stories. If you asked a lot of analysts and even companies a couple of years ago, what would normalization look like in the time period? It's been a pretty healthy normalization process. Yes, we do think that we're getting there. And so when we look at kind of the entire space, we try to think about what happens to the industry if interest rates go a little bit higher from here, if they, really the base case is that they're flattened down a little bit, but we want to look at all those scenarios. And then where we're really focusing our efforts right now are the capital market stories. So these recovery, we're in the first inning of what's going to be potentially a couple-year normalization process, and it's not going to be smooth, but there's tremendous upside to businesses like M&A advisory, probably 35% to baseline, 75% for equity capital markets. So that's really where we want to see the diversification and some of these revenue streams that have been underpunching that have upside to normalization.
All right, Devin Ryan over at Citizens JMP giving us the lowdown on banks before Morgan Stanley and Bank of America report the results. And, what he was saying about things normalizing, I'm kind of looking forward to the day where you don't have to worry about whether another shoe is going to drop when it comes to the banking sector.
Yeah, absolutely. And I felt like the last quarter, we kind of got a taste that maybe the regional banks have put this behind them. This was very specific to a very small cohort of banks.
Yeah, well, NYCB, that was not so great.
Yeah.
All right, let's take a look on how markets closed on the day. Not good if you were long equities, because we finished near our lows, off the session lows, but down 1.2% on the S&P 500. The VIX shooting up above 19. The 10-year yield moving up 8 basis points to 4.60%. We're watching, of course, 5% as a possibility for the 10-year. It kind of got there for the 2-year. And crude oil remained the star of the show and unchanged at the moment.
Yeah, unchanged, but that really belies all the volatility we saw in that, particularly on Friday and then headed into the weekend. Interesting to see what the next step is for Israel and its response to Iran.
Yeah, and you'll see that play out in the dollar, of course. This is the close on Bloomberg. Proceedings have just wrapped up in former President Trump's New York criminal trial. The Republican presidential candidate accused of falsifying business documents to cover up hush money payments to adult film star Stormy Daniels. Joining us now is Bloomberg's Kelly Lyons, who is live from the courthouse here in New York. She's downtown. Kelly, what got accomplished today? Did anything get accomplished? Because I know they were looking to select a jury.
Yeah, they have not selected any member of the jury at this point, Scarlett. What began today at 9:30 a.m. was really them needing to work through a series of motions filed by the defense, including a motion for recusal of the judge. The judge denied that. There was also a number of motions related to what could be submitted into evidence, and there were wins for both the prosecution and defense in that. On the prosecution side, they will be able to have Karen McDougal, the former Playboy model who allegedly had an extramarital affair with Trump, testify. Siding with the defense cannot be played. That's the grab her by the tape that we all know well from the 2016 election. So it was really a lot of those decisions. Jury selection proceedings didn't even begin until mid this afternoon, and 96 potential jurors were brought into the courtroom on the 15th floor of this courthouse and asked whether they could be impartial and fair in assessing this case. More than half of them raised their hands that they could not and excused themselves, which just speaks to how difficult it is going to be to actually seat this 12-person jury and 6 alternates and those who can be unbiased in a case that involves a former U.S. president. This is the first time in history that this has happened.
Absolutely. So we did get a glimpse of the former president as he was entering the courthouse. Did he have anything to say, Kelly?
Pretty familiar arguments remain in that he thinks that these charges never should have been brought in the first place. He argued that this is political persecution and an assault on America. When he was coming out of the courthouse just now in the hallway, he suggested displeasure with the idea that he may not be able to attend his son Barron's graduation. He had asked to have that day out of court in May. It was not immediately granted, and that just speaks to the wider issue that he has, which is as a criminal defendant, he is legally required to be here in person for every day of these proceedings. That will keep him off the campaign trail. It'll keep him spending money on his legal defense fees. And also, it will keep him from the Supreme Court next week, because in a separate criminal prosecution he is facing down in Washington, the January 6 case brought by Jack Smith, he has argued that he has presidential immunity, and the High Court will be considering that in arguments on April 25th. Judge Juan Merchan, though, told the defense today that Trump cannot be in the Supreme Court for those arguments. He has to be here for the proceedings, which will be ongoing, and they're going to resume again at 9:30 a.m. tomorrow as they try to continue to work through this process of jury selection.
Yeah, this sounds like it's going to be a long, drawn-out process. If half the jurors, potential jurors today, said that they can't be impartial, my understanding as well is that the judge has hit the former president with a gag order, preventing him, barring him from commenting publicly on any part of this. This is going to kind of interfere with his tendency to speak publicly about it on his social media accounts.
Yeah, and Scarlett, the prosecution already called attention to this today. Essentially what the gag order says is that he cannot speak about potential witnesses as well as other court officials, the judge and his family on social media for fear of the danger it may cause them. And yet in recent days, we have seen a number of True Social posts that have referenced Michael Cohen, the former attorney and fixer for Donald Trump, who is likely to be the prosecution's star witness. So the prosecution said today that there should be 3 counts of contempt of court because of those social media posts. They argue Trump should be fined $1,000 for each. The judge is going to consider those arguments next Tuesday, April 23rd at 9:30 a.m. But just to your point, Scarlett, on how drawn out this process will be, the judge also said today in adjourning that they're way behind schedule. Initially, the thought was that this trial would last up to 6 to 8 weeks. But one of the jurors who was excused today was excused because he has his son's wedding on June 8th in Seattle. The judge says he thinks the trial will be wrapped up by then, but just to be safe, that juror was excused.
Oh, okay. All right. Well, the first of four criminal prosecutions for Trump going to trial. Day one here, no jurors picked. Kaylee Lyons down at the courthouse, and be sure to check her out, and Joe Matthew at the top of the hour with Balance of Power. Meanwhile, right here on The Close, we're going to set you up for what to watch tomorrow with the full slate of earnings, including out of United Airlines. This is Bloomberg. Let's set you up for what to watch tomorrow. Quite a few earnings coming out, including from United Airlines, set to report. Bloomberg's Brooke Sutherland joining us right now for a preview of what to expect. And Brooke, let's just start off here as to how they're going to report these earnings. I was told that this is going to be the first quarter where we're not going to get those detailed numbers on capacity and fuel costs. They just want us to focus on the bottom line, right?
Sure. I mean, I think it'll be interesting to hear what they have to say about everything. I mean, certainly on the earnings call, we'll get a lot of color about what they're seeing right now in the market. We already heard from Delta, and I think, that's a pretty good proxy for the kind of airline that United primarily competes with, those that serve those premium passengers but also have that international segment. Those airlines are a lot better off right now than the domestic-focused carriers, those like JetBlue and Spirit, which are really struggling with too much capacity in the face of demand that just hasn't grown quite as quickly as they were expecting when they built up those aircraft fleets and their personnel.
Well, United has an issue where it had to pull the MAX 10 from its 2024 fleet. So capacity is kind of an issue for it, along with the fact that they're facing a safety audit by the FAA. So they can't basically operate at capacity.
Correct. And, Scott Kirby, the CEO, has been very vocal in his criticisms of Boeing. So it'll be interesting if he has any more to share on that front now that Boeing has made some pretty significant leadership changes. Its CEO, Dave Calhoun, is expected to step down by the end of this year. The head of the commercial airplanes division has already been replaced, and they're also going to replace the chairman of the board. So it will be interesting to see if Scott Kirby has any thoughts on that, if he feels like Boeing is doing what it needs to do to get back on track and be able to finally deliver those airplanes that it's promised to its customers.
All right, Brooke Sutherland out in Boston, a preview of those earnings tomorrow, full coverage right here on Bloomberg, but some other earnings coming out as well, including from some of the other big banks.
Yeah, Bank of America is under the spotlight right now, and of course Morgan Stanley as well, following Goldman Sachs' blowout first quarter numbers. A big question mark over how well the wealth management department is really going to deliver for Morgan Stanley.
And we get some other earnings, including out of Johnson & Johnson, United Health, and a couple others here as the earnings season starts to broaden out. And we've got a big BNEF summit tomorrow.
Yeah, we'll be watching for that. Lots of talk about the green transition and how that's playing out, over the long-term structural issues.
Yeah. All right. And we also get that big China economic data dump. Can we just call it that? We kind of get everything at once.
Everything at once. And of course, the consensus right now is for 4.8% growth in the first quarter. As Michael Hirson was just telling us, a positive number, a good print might actually be problematic because it'll convince Beijing that they don't have to do as much to boost domestic demand.
Yeah. And we were asking him about Janet Yellen's trip over there and how she was really banging this drum, not because she was concerned about China itself, but she was worried about China's impact on the global economy. And we are going to get an update of the IMF's economic outlook tomorrow at 9 a.m.
Yeah. And of course, within a world in which everyone's looking at inflation possibly slowing, continuing to slow, and at what point interest rates start to come lower, it may be that the ECB moves before the Fed.
Absolutely. Those IMF meetings kicking off in Washington. I'm not sure exactly whether people put too much stock in those numbers. They always seem to be a little bit backwards or behind.
They get everyone excited in the moment, and then things change. And so it's like a moment in time, and then you could move on.
Yeah, I think sometimes they pick up on trends, right? So maybe the trend line will be more important than the actual numbers themselves.
No, that's a good point.
All right. Well,
they identify tensions in the global economy.
Well, no matter what they say, we'll definitely have full coverage right here on Bloomberg. Scarlett and I will be back tomorrow right here on The Close. But stick around. Kaylee Lyons and Joe Matthew up next for Balance of Power. This is Bloomberg.